Hi there. There's another video that I've shot much longer than this one talking about rate volatility. And here's the thing, this video is specifically designed for the person currently in a variable rate mortgage. You're already in, you've got a discount from prime of prime minus 0.75, 0.85, 0.95. Maybe you're one of the luckies with prime minus 1.1. So you're sitting right now at a 1.85% interest rate. Amazing. Yet you have perhaps some concern that interest rates might go back up again because you heard on the news or the radio that mortgage rates have gone up. The long version of the video titled Rate Volatility that you can find at the same Vimeo channel here as this one is located, that explains that this is not the case. Your variable rate mortgage is unlikely to move upward anytime soon. In fact, it's far more likely to go even lower. If you want the full detailed explanation, like I say, there's a 16-minute long extended remix on rate volatility that explains the differences between variable rates and fixed rates. So if you're currently enjoying, a 1.85 to 2.2% interest rate or thereabouts in a variable rate mortgage, my personal advice is you likely want to stay there. But absolutely have a conversation with an independent mortgage broker, not with your lender. Your lender, again, it's buried in that 16-minute long video, but your lender has different motivations and absolutely would prefer and would profit from you converting into a fixed rate mortgage. That would be to their benefit. It is unlikely in the extreme, given current circumstances, that it would be in your benefit to lock in to a fixed rate mortgage. Enjoy that low interest rate. You're going to have it for some time to come, a year or two, whatever's left on your term. You're probably going to be enjoying a very, very low rate, especially averaged out. So as I say, be aware of the one fundamental thing that if you were to convert that mortgage to a fixed rate, that no one will tell you about. The lender won't tell you when you talk to them about locking in. No one will tell you about the difference in your prepayment penalty, and no one will dollarize it for you. So the difference is, in a variable rate mortgage right now, if you were to break that mortgage early, and I know you think you may not, but actually we're going into a time where more people than ever may find they have to sell the property, they may be transferring to another province to get a new job, and if that mortgage is with a credit union mortgage is not portable from one province to another. In fact, sometimes they're not even portable from one city to another inside the same province. And you may need to wind up refinancing that mortgage. There could be a number of different things that could trigger a prepayment penalty. As I say, we're going into a time where more mortgages will be broken than ever before, almost certainly. So right now, to dollarize that, the penalty to break out of a variable rate mortgage with 99% of lenders, with all the mainstream lenders anyways, is 3 months interest. And 3 months interest is about 0.5% of the balance. 0.5% of the balance is the mathematically, or dollarization, I should say, $500 per 100,000. So if you're like the average Canadian with a $400,000 mortgage balance, it's about a $2,000 penalty. However, the moment you convert that mortgage into a 5-year fixed mortgage, which is what most people seem to wind up converting into, even when they've only got 2 years left on their variable, they still convert to a 5-year fixed, thinking that that's a wonderful idea, not realizing that they've just made a major change to their mortgage at the 3-year mark, which statistically 2 out of 3 Canadians will do. So consider that when you go to that fixed rate mortgage with major charter banks, with the majority of credit unions, and with some of the mortgage finance companies, you will take that penalty from 0.5% of the balance, from $500 per 100,000 outstanding, upward 900%, 9 times larger penalty on average. What you'll see, it's what's called an interest rate differential. If you really kind of get someone fast talking at the other end of the phone line, they'll say IRD. IRD, what is IRD? Well, IRD stands for interest rate differential. What's an interest rate differential? You ask the person on the other end of the phone to explain to you the exact formula used to calculate an interest rate differential penalty. Odds are they cannot do it. They will not know how to explain that formula, and odds are they will not dollarize it for you. They will give you some nonsense answer like, well, it's impossible to actually predict the exact amount of the penalty. That's a nonsense answer. Sure, it's impossible to predict it to the penny, to what exactly it will be. However, certainly lenders have a long history of broken mortgages triggering IRD penalties. And they could easily tell you over the last 3 months, 6 months, 12 months, 10 years that the average IRD or interest rate differential penalty triggered has been, and that math would be about 4.5% of the balance, or $4,500 per 100,000. So again, you take that average $400,000 mortgage that the typical Canadian carries, that's the average balance of mortgages in Canada today. That is an $18,000 penalty. That is $16,000 higher than the penalty to break a variable rate mortgage, which is crazy because you've also gone from a lower rate to a higher rate. So you're actually paying more interest every single month when you convert to that higher fixed rate from where you would be potentially right now. So you pay more every month, and then should you fall into that 2 out of 3 Canadian camp, breaking your mortgage early, and should you trigger that IRD penalty, which you almost certainly will, you're going to wind up paying $16,000 more in the penalty. That's just unacceptable. And how this is even allowed, I don't understand. And if anything good comes out of everything we're going to experience, if there's a significant increase in these IRD penalties being triggered, hopefully it will trigger some watchdog, some consumer group to rally around this point and fix this thing, because it's not clearly spelled out. And in fact, there are penalties that we've seen even higher. The highest personally that I've seen a client trigger was 7% of the balance, 7% of the mortgage balance, which they literally broke down in tears. And it wasn't a mortgage I wrote, it was clients who came to me in a mortgage they had to break out of for personal reasons, and 7% of the outstanding balance. It was about a $500,000 mortgage, a $35,000 penalty to get out of that mortgage just 2 years into it. Horrific, but as I say, that's the kind of pain that I want to see you avoid. And so as I say, if you're currently enjoying a nice, deep, discounted prime mortgage, stay there. Remain calm, remain cool, because the key point is that the Bank of Canada the overnight lending rate, the Bank of Canada overnight lending rate drives prime. Prime is the basis for your variable rate mortgage. And the Bank of Canada will only be increasing that overnight rate in order to stem the increase of inflation, to stem the flow of a runaway economy. We are not headed into inflationary times. It's unlikely that we're going to see that. Very unlikely. So for the time being, enjoy that variable rate mortgage, and also know that you can usually convert into a fixed rate equivalent to or slightly greater than the remaining term. So if there's just 2 years or 3 years left in that variable rate mortgage, you may well have the option of selecting a 2-year fixed or a 3-year fixed. And the rates may not be as attractive as the 5, but the penalties are far less painful than the 5. So it'll at least give you, if you're concerned about somehow prime rising significantly, which again is extremely unlikely to do. You look at the financial crisis of 2008, 2009, again, just a whirlwind of economic bad news. Prime plummeted, and it took years to creep back up. So there's a little bit of background for you, a few things to watch out for, and I will do a separate video for the brand new mortgage shopper trying to make a decision today. Do they go variable? Do they go fixed? What do they do? Because the net rates, they're kind of comparable at the moment, at least as of March 23rd, when this video is making its way out there. March 22nd, I suppose, actually. Anyway, thank you for your time. 10 minutes, twice as long as I wanted it to be. But as I said in another video at this point, hey, we've all watched everything on Netflix anyways, so we're looking for something else to entertain or inform us. And hopefully you were informed. Probably not that entertained. It's pretty boring stuff. Take care. Be well.